Hello, I'm JP Powers, Chief Investment Officer for RWA Wealth Partners. Today, I'd like to address several critical topics impacting the economic landscape. First, we have to begin with tariffs, which have taken over markets this month. While the April 2nd tariff announcements set rates significantly higher than anyone expected, they've since been walked back, and it now appears we will end up with a more moderate level across the board, with the highest levies by far placed on goods from China. The final figures will probably shift around before we find some level that this administration settles on in the coming months, but it looks like it will ultimately be more in line with what markets were expecting earlier on this month. But even after these adjustments, tariffs remain historically high, probably the highest we've seen in the last century. These policies and the uncertainty around them poses a significant risk to both business and consumer confidence. This is already showing up in recent weakness from the survey data out of both of these groups. And who could blame them? It's difficult to make a decision as a business owner or even as a consumer in an environment where things are shifting so dramatically on a daily basis. And with respect to China, the tariff rate announced there seems largely symbolic rather than practically enforceable. And given China's record of not fully honoring past trade agreements, we should anticipate continued complexities there and must recognize that retaliation risks exist beyond just goods, potentially extending into critical service sectors that would impact a broader swath of the U.S. economy, as we export far more services there than we do hard goods. And with that in mind, we must acknowledge that tariffs themselves are a form of tax that can directly affect consumer demand, business costs, and overall economic growth. As they come online, it's going to be essential that this administration thoughtfully considers ways to offset these negative impacts, potentially through targeted tax relief, debt reduction initiatives, or other fiscal policy measures. We certainly hope to hear more on this front in the weeks and months ahead, as these could all be very beneficial to equity markets. Shifting to market dynamics. In periods of market decline, it's easy to focus on the negatives or to worry about what could go wrong next. But at times like this, it's essential for long-term investors to consider potential upside scenarios as well. When the market's down big, we need to ask, what could go right from here? And that can be tough because there are a lot of unknowns in the world and across markets right now. But when the market goes down, those lower prices create a margin of safety for long-term investors to offset some of the unknowns and consider potential upside in the years ahead. Historically, investing after a market drawdown of approximately 15%, like we saw for the S&P this month, has yielded positive returns 1 year out almost 85% of the time. And the mean return has been double digits. So for investors that can think long-term, these are often great opportunities to reposition your portfolio for future success. It certainly doesn't mean that the worst is behind us. This initial drawdown has happened really quickly. But markets are forward-looking, and so it should be expected that the economic indicators would take some time to catch up. So these could worsen even as markets begin their recovery. And we haven't really seen any deterioration in these indicators yet. So we should prepare for potential weakening in the months ahead. But because these data points like unemployment, consumer spending, and even corporate earnings reports are often backward-looking, the market may already be on its way to new highs by the time the data has recovered. So we want to be prepared to act in advance of that. The market rarely waits for some all-clear signal to tell you when it's time to get back in. Lastly, I want to put our current economic environment in some context. We certainly have some imbalances in the system today. And though we might see a slowdown in the economy in the months ahead, that doesn't have to mean a full-blown crisis like we seem to have gotten used to during recessions of the last 25 years. Today's imbalances differ significantly from those of the dot-com bubble, the 2008 financial crisis, or the COVID sell-off of 2020. The companies driving the market rally during the dot-com boom had nowhere near the balance sheet health or quality of management teams we see in the tech space today. These are now mature companies, in many cases with tens or hundreds of billions of dollars of cash on their balance sheets, and management teams with the experience and connections to see their businesses through uncertain times. In 2008, we didn't know if the financial industry would survive. And in 2020, we questioned whether the world as a whole would go on. The problems of today are not without their complexities, but much of this crisis is self-imposed. And as we saw earlier this month, could be largely reversed with one tweet, creating a historic rally. So we need to caution against taking any drastic moves that might risk being whipsawed in these volatile markets. As always, we urge you to stick with your long-term financial plans. Times like this are why you go through the trouble to create them. So rely on your advisor here at RWA to talk through any potential adjustments and see what might make sense to add value for your particular situation. Thanks for joining me, and we hope to see you on our next update soon.